Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
So there's some important macroeconomic data flashing on your screens right now. The trade deficit for the month of June has come out, and that is at about $16.6 billion, which has widened from last time's $14.6 billion in the month of May. And this is not a good set of numbers, especially after yesterday's curveball from the CPI and IIP numbers. We'll bring you more analysis with some experts, but for now, let's go across to Lata Venkatesh, who has been looking at those numbers. Lata, some not very good news on the first take.
No, actually, you should call it terrible news. This is very, very bad news. 16.6 billion. You know, when did we last have such big numbers? We had it during before the taper tantrum, when our current account deficit was running at 5.6%, and this is the last quarter of FY13 that we have had numbers as bad as this. Of course, you will argue that this one quarter you should have 16, 17 billion per month for 2 or 3 months in a row for it to become a real disaster. But this is, it's clear that imports are growing faster. Imports have grown at 21% year on year to $44 billion. So the base of imports itself is very big. It is 36.5 year ago, 36.5 billion. On that, you're growing 21%, and therefore it's come at 44 billion. Whereas your exports, as it is year ago, is not very big. It is, about 23 billion. On that, you have grown by just 17%. Even with the 23 billion base, you're growing only at 17.5%, and therefore your exports are only coming at 27 billion. I'm still not getting
which is still a shrinkage from the previous month, where exports were at $28.86 billion in the month of May. Now they've barely, they've actually shrunk to $27.7 billion. At the same time, when imports have increased, last month imports were at $43.48 billion, and now they're at $44.3 billion. So
no, I see. Normally, May is a longer month than June. June also has monsoons. So usually you cannot always compare month on month. But your point is well taken, because the May imports were 43 billion. If economic activity is lower in June, then even the imports should be lower. But imports are 1 billion higher at 44. So even seasonally adjust, if you seasonally adjust, the imports have grown considerably. Month on month, they've grown to 44 billion, 44.5 billion, and exports have fallen 27.7 even month on month, and year on year it's definitely not defensible because that is seasonally adjusted. Exports are grown only at 17 billion, whereas imports have grown 21 billion from a fairly high base, and a monthly tack of 16.5 billion is definitely unsustainable and will lead to almost 3% current account deficit as a percentage of GDP, and that's red light, that's danger mark. Well, let's get Professor Anant Narayan. He's professor at SP Jain Institute of Management. Anant, that's the deficit number, the June trade deficit, 16.6 billion.
Yeah, evening, Lata. Not great news. Obviously, the headline is at least $2 billion worse than what the market was expecting. I must caution, of course, that we have to see what the internals look like. How much of this is explained by oil and how much of this is gold and non-oil. But yes, as a headline, this is not good news, and only underlines the fact that we are looking at a current account deficit of possibly $70 to $80 billion this fiscal year. And that's not going to be made up by FDI. So we are looking at a shortfall in the gold balance and a large shortfall.
Anant, we can give you the oil and the gold imports numbers. Oil imports for the month of June are at $12.73 billion and gold imports at $2.39 billion. Both of them have actually risen on a month-on-month basis. I don't know the last year's figures.
No, I'll tell you the year's figures. Year's figures, as Anant points out, is up 56%. Petroleum, crude and crude products, the imports are up from about 8 billion to 12 billion. So that's a 50% jump year on year. And year on year, gold has fallen. Gold has fallen by about 2%. So whereas it was 2.4 billion a year ago, this year, June, it is 2.3 billion. So, I mean, I don't know how the month-on-month number squares for gold, but clearly this is crude related. But Anant, as you well know, even that also means a very good number in terms of petroleum exports, because petroleum product exports have also gone up by 52% from about 2.6 billion to, they've gone to 4 billion. Net, of course, crude is still a problem. But basically, we have to look at other electronic goods, for instance, have risen by 14.8%. Pharmaceutical imports have grown by about 46%. Machinery and electrical equipment have grown by 32%. Machine tools, 48%. Non-ferrous metals, 30%. So clearly, it looks like Indian goods are losing to foreign competition.
Yeah, broadly, that has been the trend, Lata. I think the worrisome parts are the following. One is clearly some of our exports are suffering. We know of certain sectors like ready-made garments and textiles, like gems and jewelers, and each of them have their own respective specific issues. The other part has been the fact that, oil is known. We know that we're going to have a problem because of oil. The non-oil component, if we see a large increase in electronics imports, which has been a big part of FY18, smartphones and telephones being imported, that's worrisome because, machine tools are still fine. If you're importing machinery and setting up new plants, you could argue that eventually that'll pay up dividends. But if you're spending money largely on crude, on gold, and on electronics imports, those are current consumptions. And therefore the nature of the balance that we strike on the external front becomes a lot less sustainable, and is therefore worrisome. But yes, overall, as things stand on the headlines and on the internals that you've given, it still looks like we're heading towards a current account deficit of $70 to $80 billion, which will be between 2.5% and 3% of GDP, and not good news. And one was hoping that at least with June rupee having depreciated a bit, maybe some uptick in exports would be expected, or a downtick on non-oil, non-gold imports. But I guess that will still take time to play out.
Well, there may be one positive in that pearls and semi-precious stones have fallen by about 17%. For the better part of the earlier part of this year, we saw pearls and semi-precious stones rising, but gems and jewelry exports not rising. So you're importing something which is supposed to be value-added and exported, but the gems and jewelry exports didn't rise. At least that dissonance is gone now. Pearls and semi-precious stones has fallen by 17%, but gems and jewelry exports have risen by 2%. So,
largely also attributable to what has happened in the gems and jewelry sector, the frauds and the curb, therefore, on LCs.
Also, the fear at that time was if pearls and semi-precious stones imports are rising and jewelry exports are not rising, is it some hawala money coming back? Is it using this route? Because not every customs officer will be in a position even to check whether a semi-precious stone is indeed precious or is it glass. So there was also this fear that something untoward or unsavory is happening over here. But at the moment, let's worry about that big macro, that 16.6 billion trade deficit, which, if it continues, happening over here. But at the moment, let's worry about that big macro, that 16.6 billion trade deficit, which, if it continues at this monthly rate, can lead to a much higher current account deficit. Aditi Nair, the economist from ICRA, has also joined us. Aditi, if 16 is indeed the pro rata number, what kind of a current account deficit we may end up with?
Thanks, Lata. Well, certainly today's number has come as quite a bit of a surprise. We had bet the trade deficit for this month was around $15.5 billion, so an entire $1 billion extra coming in terms of the trade deficit. And half the increase in imports, as you rightly pointed out, is simply coming in from higher petroleum imports. So that definitely is a concern. But other than that, in absolute terms, we have these big increases in electronic goods, machinery and chemicals. So certainly these are not trends which we expect would change in a hurry. So possibly we are looking at a current account deficit for this quarter of at least $16.5 billion. And for the full year, I would say that we are closer to the top end of our range of $65 to $70 billion at this point in time. So 2.5% of GDP seems to be very much on the cards.
Okay. Anant, do you expect this to cast some psychological pressure on the rupee, sentimental pressure? Do we see rupee depreciating looking at this kind of a current account deficit number?
Well, the pressure will remain, Lata. I think the good news for the rupee is twofold. One is the RBI has been pretty robust in its defense of the rupee since the beginning of this fiscal year. And we reckon that the intervention amount has now crossed $25 billion.
Yes.
So that's one big comforting part. And the RBI still has plenty of reserves in its arsenal to match, to meet immediate requirements.
But should it be defending? I mean, today actually there were economists arguing that the RBI should not be defending the rupee so much. This 25 billion, if you count forwards and spot intervention, is perhaps something the RBI should, lessen so that the rupee depreciates and the deficit corrects.
No, we've discussed this before, Lata, and I think we're both on the same page that perhaps some amount of rupee depreciation. Because even today, with all the moves that we've seen in the rupee, the RER is still showing a 15% overvaluation of the rupee. I know the RER is not a perfect measure. More importantly, our basic balance on the external front is not looking healthy. We have a current account deficit, let's say, at $70 billion. FDI, let's say, of $35 billion. We have a negative $35 billion basic balance, which we're making up with short-term, fickle borrowing in the form of FPI in debt or export or selling or speculative long rupee positions. Now, that's not a sustainable balance. Clearly, you need help to make the core balance better. And maybe, as you rightly point out, a weaker rupee could help over time balance the current account better, especially as, given the fact that we are importing a lot of domestically producible goods, and some of our exports genuinely seem to be struggling as well. Now, this will take time to play out, but I do agree that some amount of relaxation on the rupee front would be desirable. But let's also be realistic. This is an election year, and a rupee at 70 or 71 will hit the headlines and will impinge upon us immediately in the petrol pump. Yes. Our gas prices will rise. So, will the government and therefore the RBI really countenance a sharp move in the rupee is something that, we have to keep realpolitik in mind as well.
Okay. Even at 70, I think the rupee will still be overvalued on RER terms, wouldn't it, Anand?
Absolutely. So look, if you're 15% overvalued today, at 70, we'd probably be about 12% overvalued. Okay. Again, RER is an imperfect measure, productivity differences and all that. But yeah, the broad idea remains there that we would still require a little more devaluation of the rupee. Okay,
Aditi, any further comments? I mean, I don't know if you know the details, but we have not seen too much by way of gold imports on year-on-year terms. Gold imports have actually fallen by about 2%. They have come in at 2.3 billion. So it's rather oil and non-oil-led imports and not gold-led.
Absolutely. Lata, one thing I'd just like to point out in terms of the kind of contraction that we saw in the last several months in gold imports, that's pretty much petering out now. We've had double-digit contraction in gold imports since January, so for 5 straight months, and now we've just got a 2.8% contraction in gold imports. So perhaps that trend is a little bit behind us now. So once the benefits from lower gold imports starts to fade away, then perhaps that's another factor that's going to keep the trade deficits on the higher side. We are looking now at an average monthly trade deficit of 15 to 16 billion in most months. Just a couple of aberrations seem to be there. So not really looking like a very comforting scenario as far as the trade deficit is concerned.
All right, we'll leave it at that. Anant and Aditi, thank you very much for joining us. So 2 or 3 key takeaways from our experts. One, that a 16.6 billion monthly trade deficit, if it continues at this pace, can take the current account deficit higher than 2.5%. The Reserve Bank's traditional comfort zone is 2.5%. Beyond that, it is seen as a red flag, and closer to 3% will genuinely be something that the central bank will worry about. A second one, that this is not gold-led. This is crude and non-oil imports led. It could be also because growth is picking up, and therefore we have a fairly decent growth in machine tools and machinery-related equipment. But clearly a stronger rupee makes it cheaper perhaps to import certain goods. Certain things, of course, are not made in India, but it also, consumer goods, electronic imports have also come in 23% higher. So these are probably consumption items, probably iPhones and Samsung phones, which with a more expensive dollar, a dollar at 70 will at least deter some kind of imports like this. But clearly this is a point of worry for both the market and for the central bank.
All right, Lata, thank you very much for that detailed analysis. I think not a very good month as far as the macro data is concerned this month of June, but it's time now for a very short break. Don't go anywhere. We'll come back with more news and analysis.